Good morning. Nilesh Shah, the Managing Director at Kotak Mahindra Asset Management Company, joins us now. Good morning, Nilesh. Good to have you with us, especially on a day when the markets are so cheerful. What's your sense? Is there a lot of strength that we should take from the fact that there is global liquidity? Or do you think the earnings season is giving you a sense that we will be cautious?
I think it's going to be mixed. If we look at earnings seasons, the large cap stocks results have been either below expectation or in line with expectations, whereas the mid caps have delivered results which are either above expectation or in line with expectation. Even in a defensive sector like IT, mid cap seems to have delivered results which are better than expectations compared to large caps. So earnings season has been strong for the mid caps and slightly weaker on the large caps. However, on the global side, we are seeing now, returning back to the liquidity days. The European Union, European Central Bank is talking about quantitative easing. China has been releasing liquidity. They have cut their interest rate 6 times since November. Now, all these things will also put a pressure on Fed in terms of when to raise the rates. So overall, global liquidity is supportive for Indian market, and the result season has been a mixed bag.
All right, the result season has been a mixed bag. That's true. In fact, one of the big losers, the biggest loser on the index today is Asian Paints, down more than 3%. Nilesh, hi, morning. Come in on that because, the management of Asian Paints indicated that demand conditions continue to remain very subdued and they don't see recovery anytime soon. How do you play this consumption story now?
So within consumption story, we have to look at two things. One, the rural India, courtesy the slightly below average monsoon as well as the unseasonal rain of the last time, has been under fair amount of stress. It is expected that the rural economy and the FMCG companies which are focused on rural market probably are not going to have a good time. The second thing is the competition from unlisted players. I mean, clearly we have seen in recent times a severe competition from unlisted players which is hitting the margins as well as the volume growth. So on the consumption sector, while there is overall bullishness, it is far more stock specific, keeping in mind the rural distress and the competition from the unlisted segment.
Okay, actually we got very good numbers from Symphony, Nilesh. So is it that consumer durables is a play at all?
Definitely consumer durable seems to be the silver lining among the dark clouds, if you can say that. One, there has been a fair amount of discounting going on by e-commerce company, which ultimately gets passed on to the consumers, but does not hit the white goods companies by a profit bottom line. Second, there is also hope that there will be wage revision happening for the central government employees, state government employees, and public sector enterprises employees. This should result into more robust demand for the white goods. Last Diwali again was slightly below average in terms of white goods consumption. Even if this Diwali maintains a normal trend, we will see YOY growth, which will be fantastic. So put all these things together, the white goods segment today looks fairly bright vis-a-vis other consumer staples.
Okay, fair enough. One space that has been doing well this time is the mid-cap IT space. We've had good numbers coming in from the likes of KPIT, Mindtree, etc. Is this a space that you like and you would recommend buying into?
Definitely, we are bullish IT sector as a whole. Now, in the large cap space, valuations have become fairly large, and in order to generate return for the shareholders, they have to create multiple times small mid-cap companies. Whereas mid-cap companies valuations are, many mid-cap companies are even today available in single-digit valuation, and hence, if they can maintain their growth level, certainly they become very attractive from an investment point of view. The other advantage which mid-cap IT companies are now getting in is that there are certain sectors like cloud computing or digital, where mid-cap companies have certain inherent advantages in terms of their nimbleness and speed. So this combination is also helping them grow at a faster pace compared to their large cap counterparts. So definitely one should look at niche mid-cap IT companies which are specializing especially in the newer segments.
Okay. Well, Bharti results just announced. looks like the revenue is better than what the street was expecting, and as are the margins, marginally better than what the street was expecting. Idea was not in a similar boat, but both of them are showing the stress of competition and the inability to price data very high. Nilesh, generally on telecom?
See, definitely this is one sector where there is imminent entry of a big player, and that's going to keep most of the existing players on tenterhooks. They would not like to take the pricing higher and to give opportunity for the new player. Clearly the competitive intensity in this sector will remain high, and probably from a shareholder point of view, it's better to wait out and see how the competition settles in and then participate in respective stocks.
Overnight we've had the big global queue with the Chinese central bank stimulating the economy, and before that we had comments coming in from ECB where they expect to give more stimulus as well. With so much liquidity getting pumped into the system, one would have expected a big up move today, but that didn't play out. Do you think that it's a growth worry that will scare the markets now, or do you think that liquidity will be benign enough for this market to move up higher?
So today our markets are driven not necessarily by just foreign money. It's also driven by domestic money. In the month of August and September, foreigners were net sellers, and yet the markets kind of remained supported. In October, foreigners have become net buyers, and now the domestic money is also flowing in. So my feeling is that yes, the announcements of Chinese central bank or the ECB, they are supportive for global liquidity, but that does not necessarily mean that we start receiving money from today onwards. It just points to a future direction where there is a higher likelihood of foreigners being buyers rather than sellers. So our markets are going to be driven by flows from domestic investors right now rather than foreign investors, and it's also going to be driven by how the result season pans out. And as I mentioned earlier, the mid-cap result season has been, let's say, above expectation, whereas the large-cap results have been below expectations.
Okay. Well, a final question to you, Nilesh. Banks, which ones would you like? I mean, DCB got punished because they tried to face up to the small bank and the payment bank competition. But everybody has got to do that. Would you buy banks now at all, or would you fear that there is a definite coming fall in margins?
I think it's still worth being overweight private sector banks and NBFCs. Generally, for an economy to grow, the banking sector has to grow at almost twice the pace. We are at a stage where still a large part of the population may have access to the bank accounts, but they certainly don't have access to the full-fledged banking services. Even a simple thing like private banking is only reaching to a small fraction of the society rather than percolating down to all the levels. We believe the banking sector, especially private sector banks and NBFCs, will be in a position to face the competition. They will be able to reduce their margin and yet generate higher profitability for their shareholders. So notwithstanding the current talk about payment bank and small banks hitting the margin of the established players, we still think the growth opportunity is so huge that private sector banks and NBFCs remain an overweight.
All right, Nilesh, we'll leave it at that. Thanks for joining us. Well, that's the word coming in on the markets, but let's talk about one